Today, I'm going to break down the exact mechanics of a tool I see used so often, which is that of a target date fund. We're going to cover the three things that I go over first when checking through a client's target date fund options. How does the glide path work? Is the fund a to-retirement or through-retirement fund? And what are the fees and costs associated beyond the headline numbers? And my goal here is to give you the tools so you can make an educated decision when it comes to your savings plan. Now, one of the main reasons that I find that this is an important topic to talk about is because if you have an employer savings plan and you have not chosen to make your contributions allocated to the way that you want, they more than likely have been defaulted into one of these target date funds. And with these workplace retirement accounts being one of the main sources for folks to build towards their future, I think it's imperative to fully understand what you might own. On the surface, you might have read a description where it states that some of these funds move from growth-oriented or more aggressive to conservative and more fixed income oriented over time as you near retirement. Somewhat of an all-in-one design, where by picking one fund, you've now delegated the work that comes with diversification, rebalancing, and adjusting risk over time. Instead of having to juggle multiple funds and your allocation and adjusting to how markets might gyrate over time, you essentially pick the fund that has the date closest to your retirement date and let the fund do the rest. But the fact of the matter is, having a real understanding of what's going on underneath the hood could have a significant impact on your outcome. The date in the name reflects your intended retirement year, and the fund manager then determines how the mix of investment options are allocated over time. For example, a 2060 fund might have a more aggressive allocation towards stocks as we currently sit here today, but as that date approaches, they might make a shift more into bonds or cash. But not all of these funds work the same, despite the fact that there might be multiple different fund families with the same target date in the name. Each provider chooses their own balance of underlying holdings. So although you could have two funds with the exact same date, you could have two very different outcomes. In addition, a cost check could be warranted because target date funds do tend more often than not to come with multiple layers of fees. In many cases, there's an expense ratio associated with the target date fund itself, in addition to the fact that the fund might be a fund of funds in which it owns other mutual funds that have their own set of expenses. And as for savers, particularly those who don't want to be involved in the day-to-day allocation of their investments, or who don't work with a professional advisor, this convenience can be a very real thing. Now, first things first, the structure guiding the overall fund is typically known as the glide path. And the glide path defines how the portfolio might actually shift over time, making that allocation change from stocks to bonds. On paper, this could reasonably seem like a balanced trade-off. Have an allocation more towards stocks when you're earlier on in your career and might have a little more flexibility with things. And as you shift closer to your retirement date, move more into bonds as you want a little bit more stability. But the one problem with that assumption is that it assumes that the glide path works for everyone. I like to think of these target date funds as prepackaged meal prep kits. You might save time, you don't have to go grocery shopping, and all of the ingredients show up prepackaged for you. However, if you prefer a little less salt, or a little more pepper, or you want to swap out the chicken for fish, that might not always be an option. The principal thought of target date funds is similar here, in that the allocation is essentially predetermined, and you're stuck with it regardless of if it fits your risk profile or your goals. Let's take a look at where this might come into play. Two investors, Investor A and Investor B, both own target date funds in the year 2040. However, their underlying exposure to the stock market could be completely different. Investor A's portfolio has an equity or stock exposure closer to 80%, while Investor B has equity or stock portfolio exposure closer to 65%. On their statements, they both see target retirement date 2040. However, their actual underlying exposure to risk is pretty darn different in this scenario. And this caveat is more than just a minor detail, because it can absolutely have an impact on your long-term growth or portfolio management plan. An aggressive allocation might offer more growth potential. However, it could also swing more violently to the downside when the market experiences corrections or pullbacks. On the other hand, a conservative allocation could feel more stable or safer. However, it could end up getting eroded by inflation over time, which could take away your purchasing power. This brings up another critical concept, which is sequence of return risk. And that is the risk that you could start experiencing market volatility at a time right when you're ready to take withdrawals from your retirement account. Which brings me to my next point. In understanding the actual glide path and how it works in the underlying funds that you might own, whereby they typically follow either a to-retirement or through-retirement allocation. A to-retirement fund typically invests the money and goes from more aggressive to more conservative over time, reaching the maximum amount of conservative allocation at the specific date. On the other hand, a through retirement fund has your maximum aggressive allocation as you're furthest away from retirement, and it continues to reallocate and rebalance the portfolio more conservatively with a longer time horizon, somewhere extending between your 70s and your 80s. This difference could have significant implications, where a 2025 to retirement fund could end up being completely conservative this year as you get ready to retire. However, a 2025 through retirement fund could actually have up to or more than half of your portfolio still in stocks. And as we dive further into our clients' options, we tend to look at where the fees are coming from in these target date funds. Often overlooked, as who really wants to dive into all of the details, there could be multiple layers of fees as a result of what the actual fund owns. And as I stated earlier, many of these target date funds tend to be fund of funds. So to reiterate, you'll have the expense ratio associated with the actual holding or target date fund, and then you'll have additional expense ratios associated with each underlying fund that the target date fund owns. And this additional layering is great at potentially adding some more complexity to the situation when we really want to dial in and understand what these investments cost. At their core, target date funds essentially ask you to pay for the convenience of owning them. And for some investors, this potential automation and convenience might be worth it, especially, again, if they don't want to dive in and do the homework themselves, pick their own allocations, or they don't work with a financial professional for help. But for others, the potential for heightened fees and added complexities might not be worth their time. The bottom line is this: the different layers of costs, the additional potential fees, where the investments are allocated, and what their glide paths are all caveats that could have an impact on your overall outcome. Now you might be wondering, is a target date right for you? And having an understanding of which type of investor could be a fit for these funds makes it easier to put things in context. And while these target date funds can be useful solutions in some instances, not everyone benefits from them. First and foremost, they might make sense if you're looking for a low effort, simple solution. Or they could also work well if you have a very straightforward plan, you have an intended retirement age, and you don't really intend to deviate from there. In addition, they do have the potential of adding behavioral value, as I've seen investors too many times before get in their own way, whether it's buying when stocks are at all-time highs or selling and panicking when things are on the way down. Target date funds could come into play in helping you reduce temptation in those instances. And at that point, you could end up staying on track and having better chance of success with your overall plan. Although, they don't always work as well for individuals that have more complex situations. Whether you're planning to retire much earlier than normal retirement age, or you intend to work late into your 70s or even your 80s, these preset glide paths might not be for you. These funds can also pose a challenge if you have multiple different types of accounts and you're striving for tax efficiency. The degree of precision that could be needed in planning for these more complex situations isn't always available with these pre-bundled products. Similarly, if you're comfortable managing your own assets, or if you want to develop your own glide path with respect to the level of risk that you're comfortable with, this might not be a great approach either. I've also seen over time instances where savers stick to a hybrid approach, whereby they might utilize roughly 80% or the majority of their funds in their retirement accounts for a target date fund, so they could take advantage of the rebalancing and asset allocation over time, and then peel off a small portion to put into something similar to an S&P 500 fund if they're looking for more growth, or a bond fund if they're looking for more stability. Utilizing an approach like this really does depend on your goals. So I would say your best bet is to speak with a trusted financial professional. Now I want to make it clear, I wouldn't say that target date funds are inherently good or bad. They're a tool, and like any tool, the usefulness of that tool depends on who's using it and what the intended purpose is. For some, these funds might deliver the right balance of simplicity, discipline, and diversification. And for others, they could end up constraining decision-making, which ultimately might not have the best impact over time. And with that clarity in mind, let's take a step back and look at the big picture here. My simple 3-step review process of these target date funds is as follows. First, note the allocation of the target date fund at the current time. Then, look 5 years out, and then 10 years out. And this could potentially give you some insight into whether the fund is a to-retirement or through-retirement fund. Second, look at the expense ratio of the target date fund itself, in addition to the expense ratios of all of the underlying holdings. And third, scan the list of the underlying investments within the underlying funds so you can gain a better understanding of what you're actually allocating your capital to. This quick review can show you not just what might be advertised, but also what's actually going on. And if you're 50 or over, check out some of the current and upcoming rule changes to the retirement planning landscape in our next video here.